Hello dear algorithms traders, in today's article I will show you what exactly is meant by ALGO trading and to what extent the algorithms of the big players can help us in daily trading. Basically, trading is about, among other things, hitting the specific reversal points in the individual time units and deriving a profitable trade from them. There are different indicators and approaches to achieve this goal. In addition to the well-known moving average, different indicators are used to find the optimal entry and thus be profitable. An indicator that is interesting to me is currency strength, which does not exist in the futures market and gives us a lot of information about the current strength in the market. You can download this indicator for free on my channel at Forex Factory. 2 years ago I set up a German channel on the largest trader platform in the world, especially for my followers. There you will find all the information about the Bionic Candle I developed, as well as all the indicators and, exclusively, 8 videos on how to work with the Bionic Candle. In addition, you will receive interesting articles on topics such as what really moves the market. In addition, I created my own return triangle for the Euro-US dollar that gives us interesting information. And of course we talk about algorithms and why they are so important. Since there are almost 8 million posts listed on Forex Factory, it is not that easy to find my German blog. That's why I recommend you watch this video. There you will find all the information on how to easily access my German blog. By the way, more than 30,000 participants are already working with the Bionic Candle because it has significantly finer structures than the 300-year-old candle chart. In addition, there are many advantages that support you in trading, and a time saving of 33% is also not uninteresting. We already know that intellectually inferior trading coaches like to say that the futures market is significantly better than the forex market. Volume trading is nonsense from a financial mathematical point of view. We have already talked about this in detail. It is also almost impossible to make clear statements about the current market situation using a footprint chart. As a result, many traders who were trained by incompetent trading coaches lose their money every day. Particularly high loss rates affect those who try their luck with the stacked imbalance. We'll take a closer look at why you make more losses than profits in the next video. But working with the cathedral or the time and sales list is anything but profitable, because even with this information you cannot see what the big players are currently buying or selling. There are millions of retailers every day who use different approaches to try to beat the best traders in the world. Of course, retailers work in different markets and with different assets, but the fact is that in the long term over 90% of all traders lose. And so there are 3 different types of traders. First of all, we have the dreamer who is firmly convinced that trading is very easy and simple. You just have to follow the right indicator and you can make millions. Then there are the intellectually inferior trading coaches who, with their dangerous lack of knowledge, want to explain to beginners that they have found the Holy Grail. And finally, there are the realists who know full well that a professional should only focus on the cause and not the effect. The good news, first of all, it is very positive to know that successful trading has nothing to do with school education. The bad news, however, successful traders require the ability to think abstractly, understand complex ideas, and learn quickly and from experience. If we look at the distribution of the intelligence of all people, it is seen to be evenly distributed. The average intelligent person has an IQ between 85 and 115. Although IQ is neither a perfect indicator of academic success nor of work success, even critics must recognize that there is a strong connection between IQ and success. This means that there is no harm in having a perhaps slightly higher IQ, being able to think abstractly, taking new creative paths, understanding complex ideas, and learning from mistakes in order to generate success. This requires the appropriate time and perseverance. The principle of causality forms the basis for my algorithm trading. This results in the basic principle of cause and effect. The effect is associated, placed in connection with a cause. The latter must inevitably have taken place before an effect takes place. What's more, the only really hard feature that fundamentally distinguishes the cause from the effect is that the latter takes place beforehand, that is, that the effect follows from the cause and not the other way around, or that there is no sequential connection between it. It may be that the necessary biological or psychological or spiritual conditions are not present to recognize a connection. A simple example of this is a blind person who cannot see that the light comes on when he turns on a light switch. It is very short-sighted to assume that supposedly healthy people who often describe themselves as normal can comprehensively recognize all cause and effect connections. Trading coaches in particular often have significant limitations here. Rather, it is my experience that people with an open attitude, with a willingness to learn, but also people with a naturally high level of insight and intelligence, can recognize more connections. It's less a question of knowledge and more of curiosity. So, let's question, is it possible that B is the consequence of A? Or is even B the consequence of A? These two conclusions are purely logically equivalent and are the foundation for recognizing causality. If B didn't occur, does that mean it couldn't have occurred either? In our case, for example, another light switch could be responsible for the light bulb burning. It can help to question the connections that are taken for granted. Every conclusion of a cause-effect pair can be refuted by just one counterexample. An example that shows that not B holds but A still holds also immediately proves that B cannot be the consequence of A. This is logical and elementary for us traders. The fact is that the cause of all price movements are the market orders that run into the limit, order. And this is exactly where the DOM comes into play. The rapidly increasing or decreasing numbers follow clear laws that are difficult to understand with the naked eye. In the creative video How Does the Stock Market Work?, I try to explain in a playful way what laws govern the DOM and why a price goes up or down. First of all, the price just goes up and down within the DOM. There is also the time factor, for example minute or hour. During this time the DOM moves up and down, creating zigzag lines. We now want to draw a candle that was created from the second to the third minute. At the beginning of the second minute the open occurs and at the end of the second minute the close occurs. Then all we need is the high and low and our candle is ready. The cause, i.e. the market and limit orders, ensure that a candle can be created. In this case, the cause occurred before the effect. This means that the candle is only created after the DOM has moved. Since the DOM has a few trillion options for how it reacts to a market order, it should be clear to everyone that the price and thus a candle ultimately only arise from pure chance. Let's move on to another problem. We see an accident here, i.e. the result or the effect. But what was the cause of this accident? Was it human or technical error, were environmental influences such as strong gusts involved, or was it ultimately just an unfortunate coincidence? But why is root cause research important? Now, to improve or change future results. But if you don't even know the cause, you logically don't change anything. Not only candles are created from the DOM, but also volume, footprint charts and indicators. From a temporal perspective, all of these factors only take place after the cause and are therefore ultimately just a result, nothing more. And how can you use the effect to improve your winning ratio if you don't know the cause? Okay, let's go back to the DOM, since this is where the cause of the price movements takes place. Since a market order has several trillion opportunities to react in the DOM, the movements here are also only random. In addition, the big players use the retailers' invisible stops to push the price in a certain direction and ultimately enter or exit the market with invisible iceberg orders. Since all of these representations only arise by chance, it should be logical that there can be no pattern formation here. This means any patterns we see in the chart are purely random and do not guarantee sustainable profitability. Are there any patterns in the stock market that may not arise by chance? Yes, there are, but only in the programs of the big players, which always run the same way, with which they control the market and limit orders on the ask and bid side. Let's take a look at the programming that a big player uses to remove liquidity from the market in order to push the price up. The example is presented very simply. First, we define the start of the breakout at price level X and at which price level Y the main movement should end. When the breakout starts, cumulative market buy orders are fired into the market until the first stops are triggered. As soon as the first stops trigger, the big players' cumulative market buy orders are stopped. And when the stops are exhausted, new cumulative market buy orders are fired. Here we see a small M1 breakout of 54 ticks with a stronger pullback to get the long traders out again. This minute over 4,000 lot MB orders entered the market. Approximately 75 to 80% of these orders were triggered by stops from short traders, saving the big players a lot of money. If we look at the last 30 seconds in the TNS list, it looks like this. I have highlighted all market buy orders larger than 3 lots in blue. We see that the big players predominantly place small orders so that the algorithms can stop the market buy order push in time when retailer stops are triggered. As soon as the stops run out, market buy orders are pushed into the market again. In order to invest as little money as possible and still push the market upwards, limit sell orders that the big players previously filled must be withdrawn from the market. As soon as the limit sell orders on the best ask page are smaller than 10 lots, the limit orders above are deducted. This means that the market does not see that larger limits are being deleted. If a larger iceberg order from another market participant is on the best ask, the cumulative market buy order orders will be stopped and the price will be pushed downwards. The big player can collect the euro again at a lower level, and this could also lead to the iceberg order being deleted on the best ask. Then program number 2 begins again until the breakout at price level Y ends. We see different outbreaks here, and you inevitably ask yourself whether you need different algorithms for them. The answer is no, because creating algorithms is very complex and takes a lot of time. This means that an algorithm always runs according to the same pattern. Once programmed, the process is always similar. However, the volumes, the footprint and the candles are of course always different. Of course, since this is just the effect, the market does not recognize any patterns from it. However, there are clear patterns within the algorithm's program flows. The programs always have to follow the programming specifications and show the same patterns since they are only programmed once. I generate my main information from the DOM and the TNS, but we already know that these representations do not produce clear patterns that will help us in the long term. So, I had to use other ways to read the algorithms. First of all, I generate special data from the time and sales list and also some selected data from the cathedral. These are then combined, filtered, or even reprogrammed to develop a kind of ALGO scanner that reliably shows me the recurring patterns within the algorithms. However, it was a huge challenge and is much more difficult than it looks at first glance. The background is that there are many things to consider that you only learn through experience. In order to read the algorithms, there are several million options for filter settings or individual programming. The respective filter setting or programming must then be extensively tested in special situations to see whether clear patterns can be identified that lead to profitability. Since this doesn't work right away in most cases, the filter settings or programming have to be deleted or changed again and the whole procedure starts again. A very complex process that costs a lot of nerves and time. Here, for example, you can see some of the images that have been created in recent years. These are not classic indicators, and the trading volume plays absolutely no role here. For example, the top left bar indicator was generated from the current spoofing information. If we see a strong swing of the red bar to the left, there is a very high probability that the price will move downwards. On the other hand, if we see a strong swing of the green bar to the right, the price will go up in the future. We'll talk about this in more detail in a moment. At this moment, several pieces of information come in that liquidity on the ask side is increasing significantly. And now pay attention to the green top bar. This is getting bigger and bigger and shows that the price could go up more quickly. There are now even more market buy orders coming in that actually move the market. The green bar now has the largest swing and suddenly the price jumps higher. After a small pullback, which is not dangerous, stronger liquidity continues to come in on the ask side, which drives the price further up. In the end, there are 14 ticks within 2 minutes. I think that's a pretty acceptable result, especially since the information was already displayed by the algorithms beforehand. As you can see, reading the algorithms can be very helpful and useful, especially when you are in the middle of a trade and are wondering whether there could be a major pullback. The algorithms are particularly interesting in combination with my developed Bionic Candle. As soon as the price comes into my marked zone, the algorithms help me decide whether to enter the trade or not. These factors have significantly increased my winning rate in recent years. Once you've worked with it for a while, you can also see when the big players change their algorithms. Overall, the approach of algorithm profiling seems to be the right one, also because more and more big players are working with algorithms. Now, I create my main trading chart from the diverse information, although of course this constantly changes over time. The background is that I managed to delve deeper and deeper into the algorithms and thereby discover even more efficient settings that improve my trading decisions. Maybe I was able to show you that algorithms can be a profitable way. I wish you continued success and look forward to seeing you here again soon. Kind regards, Michael.